So I'll just go over the answers for the 2011 first test. The questions were, this question was, I know this question's a little bit clumsy because it's unrealistic, but the unrealistic part made the math easier. So what I'm basically saying is calculate the value of a pension. A pretty common question. Actually, your actuarial, did they go over stuff like this?
Yeah.
Okay. So yeah, that's a common actuarial question. So what I wanted to do was I wanted to make, a pension's going to have fixed payments until the person dies. I wanted to make the math somewhat easier, so I said the person will get their payments every December 31st, which is not really true. You get payments like every month. But you get the payment at the end of the year, and then the person will die at the beginning of the year, the first day. So you don't have to figure out they died halfway through the year. What does that mean? And then trying to figure out when the person dies, I just said it's uniformly distributed between 60 and 100. So there's a 1 out of 40 chance they'll die any one of those years, between 60 and 100. And then at 100, you can't live past 100 in this example. Okay, so what we want to do to say what is the risk-neutral price of this pension, it's basically, this is a question like, and you might get this question later on in life. You might have a pension and your company says, we're trying to get rid of the pension plan. We would like to give you one lump sum and say, would you agree to leave the pension plan if we gave you this amount of money? And you want to calculate what is your pension plan currently worth. So you could then take it and invest it and run something similar to your pension plan. Okay, so in this case we want to take the present value of all the payments, multiply that by the probability that you're still alive, and do that for the next 40 years. And add that up. So this kind of begs for an Excel spreadsheet or a calculator that has a pension button on it. But basically what I'm doing here is I'm saying the payments are $25,000 a year. These are the years, so I'm going to use this for my exponent. This is my rate. I just copied the rate all over the place so I can copy the same formula over and over. And then I calculate what is the present value. The present value is this number times 1 plus the rate raised to the minus 1. So 1 year's worth of interest, 2 years worth of interest, and so on. So this column here ends up being the present value of the next 40 payments. That would be under the assumption you're still alive in each of those years. So this would come down to be a total, this number right here. This would be how much your pension would be worth today, assuming you live to 100. That's what your pension would be worth today. Now the problem is you only get paid as long as you're alive, and that has a probability of happening. So now we want to multiply in the probability that you're alive. And I said this was uniformly distributed, so I basically said starting at 40, I'm going to subtract 1 for every year and then divide that by 40. And then the next one would be 40 minus 2 divided by 40. 38 out of 40 is the chance you're alive in the second year. The chance you're alive in the first year is 40 divided by, 39 divided by 40. And then this eventually goes down to 0 when we hit the 40th year.
The Excel's also on your website as well?
Yeah, the Excel's up too. So this is basically how much it's worth in today's dollars. So, for example, the payment you get in the 31 years from now, when you're 91 years old, what is that worth today now that you're 60 years old? It's worth $5,508.99 in today's money, and there's a 22.5% chance you'll be alive to collect the check. So what is that worth to you today now that you're 60? It would be worth $1,239. That's discounting for the interest rate and then multiplying that by the chance, the probability you'll be around to collect. So what questions can be asked about this with these numbers? So one interesting question is, what is your pension worth today? Once you factor in your probability of being alive to collect this stuff, it would end up being this number, $274,000. That's what a risk-neutral minded person would take today to give up their pension. Now, obviously, if you died in the first year, you would have been better off taking this lump sum, then your heirs can take that money. Okay. Now, this number, 428, what is that number? Well, we said before, that's the present value of your pension, assuming you live to 100. This is the present value of your pension, assuming you die randomly between now and 40 years from now. So a question we can ask is, that would have this as the answer, would be, suppose you wanted to have an amount of money, put it in the bank, or buy bonds, that gains 5% every year, and then takes out $25,000. You'd like to have some fund put in a bank, or a investment institution, and say, give me $25,000 a year for the next 40 years, and don't miss a payment. What would I have to give you today? If you gave them this much money and they put it in the bank, every year they gained 5%, took out $25,000. Then whatever that balance was, gained another 5%, took out $25,000. It would slowly go down to zero after 40 years. So this is the amount you'd have to start with. This is how much money you would need to guarantee a $25,000 a year payment for the next 40 years. And then after 40 years, the account would hit zero. So you have to die that year. Otherwise, find some other source of money. Okay. And then, I don't know if this is really an interesting question, how much is this worth in not present day values, just not calculating interest? What are these payments worth? Okay. And then, so what other interesting questions could we ask about this? So that was the first one. And then this is, your friend would like to mimic your pension. So your friend would need, that would be the sum of that middle column. That's what your friend would need. Now the thing is this, is having this number the same as having a pension that pays $25,000 a year? And the answer is no, this is actually better, because if you don't live till the end of your pension, this person will have some leftover money, whereas pensions don't pay anything once you die. You could have pensions where you and the person you're married to, as long as one of you is alive, you still get money, but there's different types of pensions. But assuming it's the type of pension where it just goes until you die and then you don't get paid anymore, this would have some leftover amount. And the last question was, the second to last question was, what would that amount be at a random point in time? So what we'd end up doing is we'd say starting with the balance that you got from part B. So if you got part B wrong but then set up the third part right, that would be okay. So starting with the balance you started from part B, if you then, let me go to this Excel spreadsheet, part 1B. So what I'm basically doing here is I'm saying, I'm basically, at this point, I'm taking a, on this side, I'm taking a 401k balance. The answer we started with part B. I'm saying I want to, with an interest rate of 5% and a takeout of $25,000, I want to see when this account hits zero after, after 40 years, when would this hit zero? So I'm basically saying I want to take 1 plus whatever the interest rate is in this box, multiply that by the current, the value above us, and then subtract this payment. So I'm basically saying I'm taking $428,977, I'm adding 1 year's worth of interest, then subtracting out $25,000 to get the balance the next year. And each time the balance keeps dropping and dropping and dropping, we want to see when does it hit, what starting balance would hit zero, what starting balance would hit zero at the end of the 40th year. So you end up with 1 cent left in your account if you started with that number. So you could do something in Excel like goal seek, or you could just kind of set this up and keep punching in a new starting number and just see when your balance hits zero. And so the idea is, what balance would you have to start with so you can keep taking $25,000 a year for 40 years and then hit zero? Okay. Okay, the next question was, this was a bond, and maybe I should have put in the line, I know one, I think one of you thought you pay 10,000 at the beginning, then you get 6,000 after 5 years and 6,000 after 5 years, and then they get the original 10,000 back, like it's a coupon bond. So if that were true, this would be a coupon every 5 years, and it'd be a really big percentage. But anyway, so that one, well anyway, so here's what it ends up being. It's just basically you give this money, so it's a debt instrument, meaning you give money first and then get money later. Someone is indebted to you. And then they give you $6,000 after 5 years and $6,000 after the next 5 years.
But you wouldn't get the 10,000 back, because that's the whole purpose of the bond.
What's that?
You would get the 10,000 back though, if we put in.
Yeah, but I mean, the idea that you have to get the original amount back at the end is not that's not the way all bonds are. It's basically, a bond is you're giving somebody money and they're going to give you money over time. And it's typically structured like a percentage every year and then the original amount at the end, but it doesn't have to be. You could call in a bigger part of the bond along the way. So in this case, so you're losing 10,000 and then you're gaining 6,000, but take away 5 years worth of interest, and then another 6,000, take away 10 years worth of interest. Set that equal to 0. We're asking what interest rate will make these two equal to each other. And we calculate that out. It came out to something like 0.25% interest rate per year. Then the bond duration, so the textbook shows 2 different ways to calculate bond durations. Either one is fine, right? There's the McCrulley one, but both of them have the same principle, that you're basically taking the money you're receiving and dividing it by the weight of when you received it. So first of all, before you start a question like this, we should realize you're getting some money after 5 years and some money after 10 years. If your duration is not between 5 and 10, something went wrong. So, I mean, if you got all the money back at the 10th year, the duration would be 10 years. If you got some money between 5 and some money between 10, then the duration is somewhere between the two. So you just take how much money in present value terms today and how much money and add those two together and divide by today's present value. And then it basically says this is like having this bond at that interest rate for 7.34 years. So, and I think, I did that in this question. This is a... I thought I did a duration. No, maybe it's in plus 6, sorry. Okay, so never mind. In other words, what I was thinking was, if we took a $10,000 bond and turned it into a 0 coupon bond and let it run for 7.34 years at the interest rate we had before, we would get $12,000 back. So it's kind of like saying, the duration is basically saying as you receive payments, you do nothing with those payments. You don't gain any interest on them. You just hang on to them. What would the rate of that bond then be? And it would not last the whole 10 years. It would last the amount of time, 7.34. So if you borrowed if you bought a 0 coupon bond, $10,000 at that interest rate for this amount of time, you would gain exactly $12,000. Okay, this next question was on saying that we're modeling the price of a coupon bond. So we're saying the face value times the coupon. Let's say the face value was 1,000 and the coupon is 8%. C times F would be 80, right? So we're saying $80, this is how much money you get each year. Then discount by the interest, add that all up, and then take the final money you get back at the end, the par value, and subtract that by the total amount of time. Subtract off the interest for the total amount of time. So if this is the way we would model a payout for a bond. Okay. Now this is saying, we'd like to model the bond. The probability that this company will default on any given year, given that they haven't defaulted yet, will be some value P. So let's say P was 2%. That means you buy this bond, the following year there's a 2% chance they'll go out of business and you won't get your money back, and a 98% chance they'll still be alive. If they don't go out of business after the first year, the probability they'll go out of business after the second year would be 98%, the chance they stay alive the first year and then die the second year. So that would be 0.98 times 0.02. So it would be a little bit less than 2%. So it would go like 2% and then 1.98% and slowly work its way down. So the first questions were, what is the probability the bond will default in year 7? So that means you have to stay alive 6 years, and then the company would close in the 7th year. And then what is the probability of, commonly asked question, what's the probability it'll make it to the end? So that would be the probability that it stays alive, capital T times, whatever the full period of the bond is. So then, this next question was just on taking the model above and trying to calculate in the probability they will default. So, and I know this might have seemed somewhat confusing. I'm basically defining this mu to be equal to this function. Now this made the math easy because e to the minus mu t would be equal to exactly this, which came from this answer. So now we're saying that the interest rate, this minus the interest rate here, this is how much we're discounting by, but then this ends up being the probability, well, I'm sorry, e to the minus mu t is the probability we'll default. So we'd want to take that into account too. So like in a concrete example, maybe this is a 5% interest rate, and then there's a 2% chance they'll default. So we would want to charge 7% interest. We want to treat it like it would be 7% interest. So we're just adding, so basically this answer was supposed to be that original formula with some change involving mu. And the change would show up and say, it's effectively like charging a higher interest rate because they might default. And this value mu ends up being what the financial institutions like to say the interest due to default. So you might say, well, the current interest rate is 3%, but this is a company that has a higher probability of default, so their bond rating should be at 5%. They're being charged an extra 2% of interest because that takes into account the chance they're going to default. Okay, so now the next question was, this kind of will lead into a topic we'll talk about next week, but we've hit the idea of stock options enough to know what things affect the price and what things do not. Does the current price of the stock affect a stock options price? Yeah, whatever. I mean, if you're buying with a strike price of 100 and the stock is currently selling at 120, you're already $20 in the money and you have more to go. Whatever the current price of the stock is will affect the price of the stock itself. Would the fees the brokerage charge to write the option, could that affect the price of the stock? I'm sorry, the price of the option. This one's kind of debatable. Did anyone have I think you have different answers, and I didn't take any points off for this, but is there any reason why you think it would or would not affect? If for some reason
the more brokerage fees, like the more they are,
right,
the more you have to pay for.
Right, the more you'd have to pay, but I guess if they charge the same amount on the selling side, the likelihood you'd want to buy it will drop.
Yeah.
Right, because usually when you're buying options, you're hedging, you're trying to avoid a loss on some other investment, and you want to keep that fee, you're basically buying insurance, you want to keep that fee as low as possible. And then if the brokerage house is charging an extra 10 cents per share, like let's say you're paying $2.50 per option on a share, and then the brokerage house is charging another 10 cents per share, that's $2.60. You might say, I don't want to spend that much money buying insurance, so that could affect your price. But if they're charging the selling side exactly the same, it'll make people less likely to want to buy and sell options, but the price will stay about the same. It's just less people are likely to do it. But if they started charging more on the buying side and less on the selling side, it would then push the price of the options around. So that one, I'll just say, could go either way. The volatility of the stock. So the volatility of the stock, if the stock is very erratic, would that cause the price of an option, either call or put? Now this one I said call, but it would be call or put. Would it affect the price? The more volatile the stock is, the more likely you're going to get paid off. So a more volatile stock would have a higher call price, and a less volatile stock would have a lower call price. So that would affect the price. Would the price of a call be affected by the price of the corresponding put? The put with the same strike and same underlying stock. And that was the topic we talked about, the put-call parity, where we said if the price of one starts going up, you could calculate the price of one based on the current stock price and the interest rate, what the other one should be. And if one started moving up, the other one should correspondingly move down. So if somebody started buying put options, if you're about to buy a call option and somebody starts, and the price of the put start going either up or down, your call option combined with one of those put options could create an arbitrage, so it will push the price of the other stock. I'm sorry, the other option. Okay, would the volume of the stock being sold matter? Suppose the stock is constantly being sold like every second, or the stock sells once every 3 minutes. Would that affect the price of your option? Well, how often the stock sells wouldn't affect the price unless it sold so often it started changing the volatility, and that was the previous choice, or two choices before that. And then the other thing, does the current interest rates affect the price of an option? Well, you're trying to calculate what the option is, taking a guess at what the underlying stock will be at some point in the future, and the rate at which stocks go up generally goes with the interest rate. So if interest rates started going up, the stock market would probably drop at first because people want to end up with the same amount a year later if they invested in a stock. So the interest rate would also become part of the price of calculating the stock option price. Okay, the next question was taking something we've done before and then adding one new thing, this correlated a correlation. So it basically says this: suppose Coca-Cola is selling for $100 a share and Pepsi selling for $50 a share. And you've noticed, this would never happen in the real world, but you've noticed that they are 100% negatively correlated. So if Coke went up to infinity, Pepsi would go to zero. If Coke went to zero, Pepsi would go to infinity. And the percentage by which one goes up is exactly the percentage by which the other one goes down. So one way to look at it would be whatever the price of Coke is, whatever the price of Pepsi is, if you multiply them together, it would always equal 5,000. So Coke is selling for 100, 100 times 50 is 5,000. If Coke went up to 125, that would cause Pepsi to go to 40. So 125 times 40 is once again 5,000. So this would never happen in the real world. There'd never be a 100% correlation, but there could be a less than zero, not quite all the way to 1, correlation between stocks. And so now you decide to buy 1,000 shares of Coke. But you want to make sure, you'd like to make a profit for your hedge fund, but you want to make sure you don't get creamed if the price of stock goes way down, price of Coke goes way down. So what can you do as far as options are concerned? Well, you know right away you could buy, on Coke, you could buy put options with a strike price of 100. If the stock price starts going down, every dollar it goes down, you gain $1. And the stock you bought, every dollar it goes down, you lose $1. So they'd be canceling each other out. You'd be canceling your losses. So it'd be like buying insurance. Okay, so the first question, just to kind of get the calculations going, how much money did you pay for the stock? So it's 1,000 shares times $100 a share is $100,000. Now, what options are available to you? Well, if we never mentioned anything about Pepsi, a Coke put at $100, or maybe a little bit less if you don't care of taking a little bit of a loss, you could reduce the price you're paying for the insurance, the cost of your options. You could do that if you wanted to. But anyway, if you bought Coke puts at 100, whatever the fee is you paid for those is your insurance policy, and then you can't lose any money after that. You can only win money. But because Pepsi is negatively correlated, you can buy a call, which is the opposite, a call on Pepsi with a strike price of 50. So for every $2 Coke goes down, Pepsi will go up $1. And you will get $1 of profit for every, so for every $2 Coke goes down, you will make $2 on Pepsi going up. So again, it would cancel out their, this would cancel out your losses. Now the question is, of these two things you could buy, the Coke put, or, you know, two Pepsi calls or one Coke put would give you the same level of insurance on your investment. If one of these was cheaper than the other, there's an implied arbitrage in your system because you're buying the same insurance and yet one costs a little bit different than the other. So, by the way, that company in Red Bank, TradeWorks, they have a video on YouTube. They were on 60 Minutes, and their whole business is on finding correlations between stocks. Either positive correlation, like if one goes up, the other one tends to go up 5–10% on its own, or if one goes up, the other one tends to go down a little bit, and then when they see one stock going up, they go and buy the other one. So they're doing research on what stocks are correlated to each other by past data, and then just making a bet. If one stock goes up, the other one should either go up or down, depending on what their data says, and they try to buy that, and then shortly after that sell it, and they're trying to make a very small profit, but do that a lot of times. And that's what their whole business is on, correlating stocks together. Okay. And then, let's see. Suppose you bought 1,000 shares of Coke and you bought 2,000 shares of Pepsi. So you're using the perfect hedge, dollar for dollar hedge on using Pepsi. So there's a lot of things you could have done, but let's say you did this one. You bought 1,000 shares of Coke, like we said earlier, and you bought options on 2,000 shares of Pepsi. So how much did you pay? Okay, and the price of the Pepsis, they have strike price of 50 and they cost $2.50 a share, no broker's fee. So how much did you pay for your insurance? Well, you paid for 2,000 call options, $2.50 each, you paid $5,000. So right away, you bought your Coke stock, and then you paid $5,000 for insurance. So you paid a $5,000 fee. Now you can't lose money, you can only win money. So now the question said, and I guess you could kind of draw on a graph here, but what's your payoff curve? And the payoff curve ends up being like a hockey stick, meaning a flat line and then it shoots up on an angle. So basically, while Coke is under 100, if Coke goes below 100, every dollar we lose on Coke, we gain the same amount off of the Pepsi options. So if Coke goes below 100, we lost the insurance. Once Coke goes above 100, we start getting some of the insurance back. In fact, we might get so much we make a profit. So we just take the price of Coke subtracted from 100. Everything above 100, we gain $1,000, and then we have to subtract whatever our insurance was. So it turns out if this got to 105, our profit would be zero. We would make $5,000 and we'd lose the $5,000 we paid to insure it, we'd be back to zero. So we need the stock to go to 105 just to break even, and then everything above 105 is a profit to us. And our worst case scenario is the $5,000 loss. Okay, so, and the last question is this binomial lattice one. So, trying to draw a lattice in Excel, but that really didn't work out too much. But anyway, what I'm saying here is, I'm saying we're starting at $4, and then if with the market goes up, it goes to 8, or with a 50% chance it'll drop to 2. And then at $8 it can go up to 16 or drop down to 4. And if it went down to 2, it could go up to 4 or down to 1. And the probability after 2 years, because each of these has a 50% split, the probability of this stock being worth $16 is 25% chance. The probability the stock is worth $4 is a 50% chance, because there's 2 paths to get to it. And the probability that the stock is worth $1 is 25% chance. So the overall expected value would be multiplying the price times the probability it hits that price, and sum that up. So we'd have 4 plus 2 plus 1/4 is 6 1/4. Okay. So now we could say, what is the, what questions could we ask about this? So the expected value is 6 1/4. The variance would end up being, a variance calculation would be, a variance calculation is over here. Okay, so the expected value of x squared would end up being 6 1/4 squared, which ends up being 39.06. The probability of each of the, now I wanted to get the term of the expected value of x squared. Not the expected, not the expected, not the, not the, not the, not expected value of x all squared, but the expected value of x squared. So that would end up being the 25% chance it would be 16 squared, so that's 256. 50% chance it's going to be 4 squared, which is 16, and a 25% chance it would be 1 squared, which is 1. And multiply the percentage of it happening times the amount, gives you these numbers, and we add that up. This ends up being 72 1/4. So now we subtract 72 1/4 from the expected value of x squared, which is 39, and that gives us 33.1875. That ends up being our variance for this particular set of data. And then the square root of that ends up being what the standard deviation is. And what else do we ask? Okay, so now we're saying for this price, now this is like not being realistic, however, we could use this to model something realistic. We're saying if, there was a stock option, a put option, right? Put option? Yeah, put option, with a strike price of 7 that expires 2 years from now when those numbers come in, what would that be worth today? So, let's see if I remember where we saw this. Okay, so it's in here. So what I'm saying here is the stock price could hit 16, 4, or 1 with a 25% chance, 50% chance, and 25% chance distribution. The strike price is 777, and I did that just so I could put formulas in boxes and copy all the formulas. The option's future value, if the stock price hits 16, we get everything below 7, because it's a put option, we get everything below. So everything below 7 would be 0. If the stock price hits 4, everything below 7 is 3. So, right, 7 minus 4 is 3. So that's what that 3 is. And then if the stock price hits 1, we get $6. 7 minus 1, because it's a put option, we would get $6. So, if you multiply the chance it happens by the value we get, we end up with 0. 50% chance we'll get 3, so that's 1.5, and a 25% chance we'll get 6, that's also 1.5. That adds up to $3. So 2 years from now, this stock option is expected to be worth $3. So what would you pay for it today? We would just discount back based on the interest rate, and that comes out to $2.72 is what you pay today for a $7 put against the market of this stock, where it either doubles or cuts in half every year. And anything else? oh, after the first year, what would the stock, if the market went down the first year, what would it then be worth? So we just kind of, it's the same question, but much less time and less probability. So at this point, the stock price, if it went down to 2 after the first year, it can never go to 16, right? It can only go to 4 or 1. So at this point, there's a 50% chance we'll go to 4, a 50% chance we'll go to 1. And again, the stock price is 7, same payouts as before, but now it's 50% times 3, which is 1.5, 50% times 6, which is 3, and then just add these two up, we get 4.5. So now this is 1 year down the road, right? This was a 2-year lattice, but it's saying after 1 year, what would you now pay for this option? So it's expected to pay $4.50 1 year from now, so what would you pay today? You would discount back 1 year's worth, not 2 years' worth. The question was saying, right, didn't it say what would it be worth then, at that point in time? After the first year goes by, the stock goes to $2, what would the price of the option be at that point? So then you discount it back 1 year.